There are no smaller items with smaller transactions. And so when we say small, we think of the grand scheme of the total capital markets or M&A market for businesses. And so from one end of the spectrum of companies that are generating $500,000 a year, all the way to the other end of the spectrum where companies are generating billions of dollars of profit a year. So when we generally say the middle market or lower middle market, we define it in our way as privately held businesses, family entrepreneur, small investment group owned, generally producing $400,000 to $4 million of EBITDA pre-tax earnings. And so these are sizable businesses. However, in the grand scheme of all private and publicly traded companies, you can still think of them on the smaller end of the overall spectrum. And therefore, the mantra for today's video, that there's no smaller items, there's no smaller considerations for smaller transactions, is important to keep in mind. I think we all have this idea of mergers and acquisitions from the old 1980s private equity buying gigantic publicly traded companies and then carving them up or winding down certain pieces or accelerating others with lots of fat on the bone. And so you think of the KKR Nabisco deal, or a lot of the deals of that era where people were buying companies and either laying off, firing, or closing things. What was the movie Wall Street, Teldar paper? Things like that. All of the vice presidents who pushed paper around and yada yada from the Michael Douglas speech. But in modern day private equity and acquisitions, things are already fairly streamlined at many of the companies that are doing the acquisitions. And so many times the acquisitions themselves are more driven by access to customers, by capabilities, by innovation, and certainly by the fundamental economics, but it's much less of the buy and slash and burn that maybe it was when I think corporate America was perhaps a bit more inefficient. And so we like to think, and I believe it was Marcus Lemonis that may have had the construct or the framework, but you think of a business as people, process, and products. Products can be more generally perceived as products, services, or offerings, but in each of these categories for transactions that fit our specialization of that middle market, lower middle market area, it's really keen to kind of know each of these components down to a very minute level, because again, there's less room for error, there's less margin, there's less fat in these types of businesses. They tend to run like very well-oiled machines, and so being able to define these components creates a lot of value throughout the process. And so we think of people, we always think of who does what. I know that sounds like a simple question, but if you can break down all of the kind of activities of the business and you allocate different people to which, does everybody do something, and does anybody do too many things? And sometimes in this area of spectrum, right, there's an underdevelopment at times of the human capital or infrastructure of a business that at times can create too much key man or woman risk in a particular situation. And so being able to define that and having people perhaps cross-trained, so even if you do have a lean staff, having circuit breakers or backup for different tasks or objectives of the company helps in mitigating risk and enhancing value. Second is processes. And so as you're allocating those people to the activities of the company, oftentimes you're bringing to light or elucidating the processes of the company. And so being able to define each component of a company, you think of origination being the sales side of it, execution being the actual work being completed, and then whether it's customer satisfaction or relationships, and then you can have other elements to it as well, finance, procurement, there's a lot of different components. But if each of these elements, and they will be different depending on what type of business it is and the unique elements of the specific business, but if each of these processes can be defined as, yes, this is how it works, the Plinko chip from The Price is Right falls through it this way, and this is where it comes from, and this is where it lands. That's important for any process. And again, companies of this size, very important to show that there's a laser focus on how each element of the business works, because again, there's not this gigantic corporate infrastructure where there's a bit more tolerance perhaps of some sloppiness or inefficiencies. In a small business, you see it right away. Therefore, it's very important to capture these things succinctly. And lastly, when it comes to product, service, or offering, it's again important to show, and we alluded to it in the last video, and we say it all the time, but it's important to show why the offering of the company does not rely on being the lowest cost provider or having the cheapest cost of capital. Again, what is the proprietary element? What gives it the edge? What is the thing that they're selling? Who are they selling it to? How do they capture that audience? How do they retain that audience? And oftentimes, with smaller businesses, there are niches that they're in, there are hyper specializations, there are things that they just do incredibly well, and oftentimes that's what garners much of the value as these companies are moving up into the private equity food chain, if you will. So being able to highlight that is important and creates a great deal of value. And so that's the thought. There are no small items or considerations when dealing with smaller companies. The reason being is there's not fat on the bone. The company is oftentimes very focused or specialized in a particular area, vertical or sub-niche, and its people are key to the business. So in light of that, it's important to highlight the good parts of this as well as the lack of issues and mitigating preemptively any of the risks. So the questions will always come, well, given this is a smaller company, how do they deal with X person not being here? How would they deal with X supplier not being able to give them what they need? How would they survive X part of the process breaking down? And so if there's redundancies, again, not necessarily in people, but in capabilities, in resources, in planning, it mitigates risk, it enhances value. So that's a thought for today. Hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see everyone next time.